There's a phrase I've heard over and over again during more than a decade working in the U.S. financial industry. Bitcoin is good, but it's too late. What's interesting is that this phrase didn't appear for the first time today. It appeared when Bitcoin was at $1,000. It came back when Bitcoin reached $10,000. And now, as Bitcoin enters six-figure territory, the exact same sentence returns. Unchanged, word for word. Each of these price levels created an entire generation of people who stayed on the sidelines. Not because they weren't intelligent. Not because they didn't understand the technology. But because they were afraid of being wrong. As a financial advisor in the United States, I can say this very clearly. Backhand index pointing right, the fear of buying the top has cost more people more money than any crash in history. They didn't miss the opportunity because the price was high. They missed it because they were waiting for a feeling of certainty, something that has never existed in investing. And while most people remain trapped in that fear, there is one reality very few are willing to confront. Bitcoin is the first asset in human history with a supply that cannot be manipulated. Stocks can be diluted. Bonds can be eroded by inflation. Real estate can be taxed, regulated, or rezoned. But Bitcoin cannot. 21 million is 21 million. No one has the authority to change that number. In a world where everything can be printed, Bitcoin has become a dangerous exception to the old system. And here's the paradox. Despite all the attention it receives, Bitcoin is still incredibly small in the context of global assets. After more than 15 years, Bitcoin represents only about 0.1% of total global wealth. On Wall Street, we have a very familiar term for situations like this. An asymmetric opportunity, where downside risk decreases over time, while upside potential has not yet been fully priced in. Because Bitcoin doesn't need people to believe in it. It only needs them to hedge risk. A 1 to 3% allocation across portfolios would be enough to create pressure that no traditional financial system could ignore. So the real question isn't, is Bitcoin too late? It's this. Backhand index pointing right, are you afraid of Bitcoin's price, or afraid of admitting that you waited too long? If you've stayed with me this far, you're probably asking yourself, alright, if Bitcoin isn't too late psychologically, then what about practically? Let's start with a truth the traditional financial system rarely says out loud. In the entire history of investing, there has never been an asset whose supply is completely immune to intervention. Stocks can be diluted with a single decision from a boardroom. Bonds can become meaningless when inflation runs far beyond yields. Real estate, despite being marketed as safe, can still be taxed, regulated, or even frozen. Bitcoin is different. Not because it's exciting, but because 21 million is the final limit, locked in by mathematics and enforced by a global network. No central bank, no government, no corporation has the authority to change that. That rigidity is exactly what makes Bitcoin an uncomfortable exception in a world accustomed to printing money. And here's the next paradox. Despite the controversy, the criticism, and being labeled a bubble for more than a decade, Bitcoin still represents only about 0.1% of total global assets. Pause for a moment and let that number sink in. After 15 years. After thousands of headlines. After countless boom and bust cycles. Bitcoin remains a tiny in the roughly $1,600 trillion global asset landscape. On Wall Street, when we see something like this, we don't call it risk. We call it an asymmetric opportunity. Because Bitcoin doesn't need people to love it. It doesn't need them to understand blockchain. It doesn't need them to believe in a revolution. Bitcoin only needs people to hedge risk. American investors don't buy gold because they love metal. They buy it because they don't fully trust fiat currency. And Bitcoin is steadily moving into that same role, but more efficiently, more flexibly, and on a global scale. All it takes is a 1 to 3% reallocation of global asset portfolios. Not everything. Not the majority. Just a small fraction. The resulting supply-demand pressure would be enough to completely reset the price landscape. And the reality is, that flow of capital has already begun. BlackRock, an institution that once dismissed Bitcoin as a joke, now runs the fastest-growing Bitcoin ETF in history. A small country like Bhutan quietly accumulated Bitcoin, only to realize it now represents nearly 1/3 of its GDP. Meanwhile, millennials, the generation set to inherit the largest transfer of wealth in human history, understand Bitcoin far better than the generations before them. Which brings us to a larger, less discussed truth. Bitcoin is not just an investment. It is a transfer of financial power. For the first time, individuals can store wealth themselves, transfer value themselves, without permission, without intermediaries. Bitcoin weakens the very pillars the old system depends on: custodial monopolies, capital controls, and the silent financial fees that erode your wealth year after year. And when Bitcoin is packaged into an ETF, convenience increases, but freedom decreases. An ETF is a promise on paper. Self-custodied Bitcoin is a real asset. In the United States, we have a term for that difference: counterparty risk, the risk of trusting someone else instead of yourself. And now, let's talk about the part most people are both curious about and quietly avoid: the numbers. When someone hears projections like $1 million or $2 million per Bitcoin, the first reaction is usually a dismissive smile. It sounds unrealistic. It sounds like a story designed to sell hope. But here's the problem. Mathematics doesn't care about your emotions. If less than 1% of total global assets were reallocated into Bitcoin, just a thin slice of a $1,600 trillion pie, a price around $1.2 million per Bitcoin is not an extreme scenario. It's basic division. Bitcoin doesn't need to replace the entire financial system. It doesn't need to defeat stocks, real estate, or bonds. It only needs to become a better option for a small portion of the old system. And in a world where bonds yield 3% while inflation erodes 6%, that bar isn't very high. But then the familiar objection appears. I understand the potential, but Bitcoin is too expensive now. Let's look honestly at the financial reality of modern society. In the United States, credit card debt has surpassed $1.1 trillion. More than a quarter of Gen Z relies on, buy now, pay later apps just to cover basic necessities. And nearly half of millennials admit they delay marriage not because of a lack of desire, but because of financial insecurity. In a system like this, every scarce asset looks expensive. Not because its price is irrational, but because your money is losing value faster than your ability to accumulate it. So when someone says, Bitcoin is too expensive, it's usually not a statement about Bitcoin. It's a confession about the financial pressure they're living under. And it's precisely in this environment that Bitcoin becomes more dangerous than ever to the old system. Because for the first time, an ordinary individual can own an asset. Without a bank. Without a broker. Without asking permission. When you own real Bitcoin and self-custody it, no one can freeze it. No one can seize it. No one can dilute it to bail out a failing system. By contrast, when you own Bitcoin through an ETF, you own a promise, not the asset itself. A promise that still depends on exchanges, fund managers, policy decisions, and what happens during a crisis. Financial history teaches us a costly lesson. Everything works until it doesn't. And when that moment arrives, the difference between convenience and freedom will no longer be an abstract concept. It will determine whether you control your wealth or stand in line waiting for someone else to decide for you. So when we return to the original question, is Bitcoin too late? The answer isn't found in emotions, headlines, or today's price. It's found in mathematics. It's found in capital flows. And it's found in how the financial system actually works. Bitcoin doesn't reward people who perfectly time tops and bottoms. It doesn't reward those who chase daily news. Bitcoin rewards those who understand what they are holding and have the patience to stand firm while the majority hesitates. The reality is this: the global asset reallocation hasn't truly begun. Most of the world still hasn't allocated even 1% of its portfolio to Bitcoin. And as that number slowly moves toward 5%, what is dismissed as fantasy today will look obvious in hindsight. But early never means easy. Early means taking responsibility. It means educating yourself. It means making your own decisions. And it means being willing to move against the crowd for a long time. So the real question isn't, will Bitcoin continue to rise? Mathematics has already answered that. The real questions are these. Backhand index pointing right, will you approach Bitcoin as an observer or as someone who understands the game? Backhand index pointing right, will you own it on your terms or on Wall Street's terms? If this video helped you realize that too late is just a psychological trap, hit like so the algorithm can share this message with more people. And if you want to continue these quiet, thoughtful conversations, honest discussions about money, assets, and financial sovereignty, subscribe to the channel. Finally, leave a comment below. Backend index pointing right. What is holding you back from Bitcoin right now? The price? The fear of buying the top? Or the feeling that you arrived too late? You're not the only one asking that question. And real understanding begins with conversations like this. Bitcoin hasn't left the station, but the engine is running. And financial history shows us this. Those who prepare early never need to rush. The decision is yours.